Good evening, guys. If you haven't seen our intro video, you can scan this QR code and watch that at your leisure. This goes through the background, my background, why I'm so passionate about all of these topics, and talk about some interesting tax mitigation strategies and some other stuff that you'll find interesting if you haven't seen it. Tonight, we're going to be going over some interesting tax strategies with Chris Shakowitz. He's been with us a number of times. Met Chris through a mastermind with Tim Bratz. I've been in that mastermind since 2020, I believe. Typical disclaimer, I'm not a CPA, financial advisor, attorney. We can't guarantee any outcome. There are risks with investments, and there's risk associated with these tax mitigation strategies as well. The majority of them work well if you do them appropriately and do all your appropriate documentation. For those of you that don't know me, my name's Tyson Cobb. I'm a semi-retired orthopedic surgeon. I left my group in 2019 and moved into real estate and other alternative investments. Learned how to do tax mitigation. It's allowed me to work less, make more, and pay a lot less in taxes. As you replace your active income with passive income, you get your time back. Allows you to live life by design, which has been a beautiful thing and a great transition for me. We recruited Donato as our chief financial officer Q4 of last year. He spent some time at the Department of Defense, entered real estate during COVID, acquired 176 units by the age of 23. He was the former director of acquisitions at one of the major multifamily investment firms in the U.S., and that's what he does with Timberview Capital. So he leads our acquisitions, deal sourcing, and investment structuring, and also runs our masterminds. Tracy Rommel is Director of Investor Relations. She spent 17 years in private banking. She was my private banker for 15 years of those, and she handles all things investor relations. So if you need any help with investments, filling out your paperwork, doing your letters for accreditation, if you need intros to people like Chris that you'll meet tonight, or need help setting up self-directed accounts so you can invest through your retirement account and alternative investments, she can do all of that for you. What do we do here at Timberview Capital? I spend most of my time researching and vetting deals. We're able to negotiate superior returns for our investment network because we place a lot of capital, about 40 million a year, and that opens a lot of doors, allows us to get into a lot of really good investments, and we're able to negotiate better returns because of the amount of capital we place. I'm in 8 to 14 masterminds or paid groups at any given time. And we meet a ton of really highly skilled people like the one you'll meet tonight. And we're happy to share those and make introductions if you're needing help with something. We host a lot of educational webinars. And as I mentioned, we have a couple of masterminds for people that want to dig in a little deeper. Our mission is to be a trusted partner on your journey to financial success. I've walked the path and been through from a full-time busy orthopedic surgeon to work optional, and we're happy to help you follow the same path and can introduce you to people that can help you along the way. As I mentioned, we have a couple different masterminds, and I'm going to turn it over to Donato and let him tell you about them.
Thank you, Tyson. The Cobb Club we created in Q4 2025 as an opportunity for us to serve our Timberview Capital audience members in a higher, more intimate way to provide even additional resources and benefits. And the Cobb Club is our private white glove membership that provides all of our credit investors in our network the opportunity to access improved investment economics when available on a deal-by-deal basis, get advanced tax optimization education, and personalized support over the course of your investing journey. What that looks like inside the Comp Club is a variety of benefits that members are privy to, including early access to deals and underwriting frameworks before public release, in addition to invitations to annual retreats we host both domestically at Tyson's Farm in Southern Illinois and internationally in locations like Cancun. We bring together like-minded individuals who are part of the Timberview Capital Network to network, mastermind, and workshop with each other, looking at live deals and talking about how we can better each other on our pursuit of full financial independence and being around people who are like-minded. We focus on tax optimization education and helping turn you onto different strategies such as cost segregation, real estate professional status, short-term rental tax loopholes, SDIRA planning. We achieve that through calls just like this, which are wealth strategy calls, where we bring on expert insights from a variety of different network of CPAs, attorneys, cost seg providers, financial advisors. We're able to come on, talk about what they do, how they operate, how they can help you, as well as provide discounted access to the services they might therein provide. We also provide improved returns on a deal by deal basis. What this means is on a variety of deals that we participate in, we create what's called the Cobb Club class of shares, whereby being a member of Cobb Club, you are privileged to be able to participate in any investment offering at the Cobb Club class of share level. And those shares, depending on a deal by deal basis, will provide you a either better cash on cash return, higher equity multiple, lower minimums, or other types of financial benefits simply for being a part of the Cobb Club. Finally, the Con Club members enjoy priority consideration for oversubscribed deals and enjoy lifestyle benefits such as our member property exchange. So far in 2026, we've been able to launch at this point now, I think that's 13 deals that have had a Cobb Club benefit, which means that if you are an active investor and you participate in all of these deals, you would have made an extra $210,000 projected earnings on these deals compared to a general Timberview audience member simply by participating in these deals while being a Cobb Club member. So in this case, it literally pays to be in the room. Finally, we just recently launched our Timberview Academy. We're very excited about this. And this kind of operates on the other side of this Cobb Club spectrum, where Cobb Club is designed for people ready to take the next step and grow and evolve into developing into expert investors. Timberview Academy is designed for people who are trying to go from 0 to 1. The whole goal is to help you learn, grow, and impact, built for high-income professionals, help learn proven investment strategies, how private investments work, what the different terms are, and basically letting you walk the walk and talk the talk with the ultimate end goal, making you feel successful enough and confident enough to make your first or next private investment in the first 6 months. The whole goal is to bring you together with like-minded individuals who are looking to walk this path the same as you are. We're very happy to announce that Timberview Academy is designed for philanthropy, with all profits going to charity. It's all about helping you take the next step and give back in the same time. If you're interested in learning more about the Timberview Academy and being able to get exposed to the content modules and the overall educational materials designed to help you take that next step, and scan that QR code and be invited to join the Timberview Academy. And next, on our next slide here, if you have any conversations or want to have a conversation or ask any questions around Cop Club, Timberview Academy, or anything else that we do here at Timberview Capital, you can scan that QR code. It'll go ahead and put a time directly on my calendar for us to have a conversation. Be more than happy to sit down with you, talk about your investment goals, and see how we can connect in 2026. And now, without further ado, I'll go ahead and introduce our guest and co-host this evening, Chris Shakowitz. Chris is a tax strategist specializing in capital gains reduction and income tax savings. So keeping more of what you earn. He offers customized tax strategies tailored to high net worth investors. And his expertise in over 25 different tax mitigation options for reducing your taxable income, primarily focusing on clients with wealth in real estate, crypto, and a variety of different businesses. Chris, it's great to have you on this evening. Please go ahead and introduce yourself to the group.
All right, thank you. So I'm Chris Shakowitz. I'm with deferredtax.com. And what we do overall is we help people determine how to preserve and grow their wealth. And we do that by leveraging an integrated plan, which includes wealth management, tax planning, estate planning, and risk management. Today, what we're going to do is specifically drill into tax planning. And then specifically, I'm going to show today 3 income tax reduction strategies, as well as 1 tax-free retirement strategy. So let's go ahead and begin. So from an income tax reduction strategy, the first one here is called a fee simple donation. So what it does is it allows you to deduct up to 30% of your income by investing essentially in a mining concern. In this particular case, this mining company's been around for 30 years. They've done, many, many different mines across the country, but all they do is they mine granite out of the ground and then crush it up into aggregate. And that aggregate is used to build roads and concrete, essentially as a construction material across the country. So what they do is they find a viable mining site, they buy it, They drill holes in the ground, determine what the value of the granite is within the ground. They then figure out the economic value of it by doing a discounted cash flow against the Department of Transportation, either the state or the federal, which essentially is the biggest consumer of this aggregate. And then they do a discounted cash flow to figure out what's the value of the land. So the difference of the value of that land, the net present value of the value of that land, if you built the mine versus the bare land, that difference is where you get the tax deduction. This company's been doing this for over 14 years. They've done over 28 of these particular investments. They are 100% audited. However, it's audited at the GP level, not at the LP level. So you would be an LP. The GP is the one who's actually running the fund. And for every dollar invested, you'll typically get about $2 back in tax savings, depending on where you live in the country and what your state and federal tax rates currently are. So essentially, it's allowing you to do for a $1 investment to get a $5 tax deduction. That currently, if you basically invest early, so essentially early in the year, usually before October, you can actually get a $5.5 deduction for every dollar you invest. So this is called the fee simple donation, and it's good for up to 30% of your AGI. The other solution we have is called a historic preservation easement. So this one gives you about a $2.50 charitable contribution for up to 50% of your income. And then this investment, it typically lasts for about 5 years, which in year 6, they will sell. And then essentially you'll get your money back plus any appreciation. This company basically focuses on buying historic buildings that are near skyscrapers. So like in the picture here, you've got this multi-story historic building, but it's got massive skyscrapers all the way around it. If the property is not this is properly zoned, you can buy that property, knock it down, and then just go build another skyscraper, which would be the highest and best use of the land. Well, in the tax code, IRC 170H, it basically allows you to essentially buy that building and then put an easement on it, which would protect the facade and the airspace in perpetuity. So you can't build up and you can't change the outside. You can use the inside for whatever you want, but it basically will preserve that historic building. So for every dollar you invest, you get a $2.50 deduction for up to 50% of your income. And basically, this one was expecting, well, anyway, the numbers on this one will change for this year, where they're going to focus on, instead of trying to do a preferred return each year, they're going to do essentially bigger returns. So basically, 3 bigger returns during the year as one-time payouts each. And then on the back end, they're expecting to be to provide a significant multiple on the return on investment, where previously they were expecting that to be a 30 to 50% return on the back end, plus the return of your original capital. Now they're thinking that this is going to be closer to a 5x return on the back end. So much improved return on investment on the back end for this one this year. So then what we can also do is basically combine the two. You can take the first 30% with the fee simple donation, which would give you roughly $2 back for every dollar you invest. And then for the other 20% to get to 50%, you can then combine it with the historic preservation easement at the 2.5 to 1 deduction. So if you take a look at the next page, this last option kind of gives you the biggest bang for your buck. But this is just a high level example for illustration purposes only. Assuming somebody made $1 million, their 41% marginal tax rate in the state of Ohio, because they're married, they made $1 million, we can essentially get a $500,000 deduction. And we can either do that in this first column under historic preservation easement near the middle bottom. You can see that a $200,000 investment would give you a $500,000 tax deduction at that 2.5 to 1 ratio. Conversely, if you use the fee simple donation for that 30% deduction, you can invest essentially $60,000 at a 5 to 1 to basically get a $300,000 deduction. Or you can combine the two, where you're getting that $500,000 deduction by putting 80,000 into the historic preservation. Sorry, you're putting 80,000 into the historic preservation, 60,000 into the fee simple. So it's a $140,000 investment, gives you a $500,000 deduction. So these are pretty powerful strategies. I do have more details I can share one-on-one, but for per SEC regulations, I can't go into more detail than we have so far on a general forum like this. Now, in terms of the restrictions, investors must be accredited, so it cannot be someone who is not accredited. Both of these investments have built-in audit defense funds, and any audit would be against the partnership and not against you as an individual. Both of these companies have excellent track records with the IRS, where they never paid basically a penny to the IRS because of an audit. And both these investments are designed to be audited. So essentially, the paperwork is created by people that used to work at the IRS and prosecute these transactions. Um, and in addition, the firm who basically created the fund is the same firm that would basically protect you in an audit. On the next page. We also vet these solutions by taking a look at who the provider companies are. We want to look at the owners, and we want to see people with extensive experience, direct ownership, and we want to see the owners actually invest in these same products that you're investing in, so they have skin in the game. We also look for an audit history where they've been tested by the IRS and won. We look for companies that have survived tough economic times like the financial crisis in 2007. And in addition, we're investors just like you are, so we actually use these solutions ourselves. So these are legal strategies. You must be accredited, as I said. Um, these options exist in the tax code for a reason. They were placed there in the case of the fee simple to preserve open space and waterways. And in case of the historic preservation easement, they were placed there to protect historic buildings. In both cases, the government doesn't have a fund to buy these things and preserve them. So they basically create tax deduction to get investors to invest capital that would then create these scenarios based on the direction of the tax code. However, some people have abused the tax code in the past, so the IRS is always looking for abusers. And these particular solutions are the types of things that people tend to abuse, so they do heavily scrutinize these investments. But once again, they are any audit action would be against the investment company and not against you as an individual. And while past success does not guarantee future success, these provider companies meet our vetting criteria, but it does not prevent legal challenges or guarantee success in an audit. So our whole approach here would be to take any savings that you have, instead of going out and buying a Ferrari, you should basically go invest it with somebody like Tyson, where you can basically, double your money. And then if something should happen in an audit, at least you will have made a profit on that money before you have to pay back the IRS part of it. Okay, so with that as a quick rundown, those are solutions that we've been providing for 4 years now, actually 5 years for the fee simple. What we're doing today is we're also introducing something new. So this is a tax-free retirement strategy where we can generate tax-free income. So if you're seeking the potential for more retirement accumulation to maintain your current lifestyle, protect and more protection for you and your family in terms of how you're planning for your income when you retire, as well as diversifying your assets, we have a strategy. If we go to the next page. And basically, it's the whole idea is leveraging other people's money. So we use leverage to buy our homes and to buy cars, but one of the powerful use cases for leverage would be, for example, buying an investment property. If you bought a property and had put 25% down and 75% you used bank financing, well, the appreciation is 100% appreciation for you. So you're paying interest to the bank, but you get the appreciation on 100%. So that leverage, increases the value of that real estate investment over time at a higher rate than if you just bought it with your own money flat out. Well, this retirement planning strategy does the same thing, but it does it with a retirement plan. So we like to call it smart leverage. The idea is to grow your retirement funds through tax-deferred and leveraged investments, and you would essentially create a no interest loan. That no interest loan would essentially magnify your principal when you're basically doing to the investment, and this investment is in an insurance product. And what that would do is compound the income without using your money. You would be using the bank's money. Now, in this particular case, there is no credit check, there's no interest payments, there is no personal guarantee. Um, the distributions made from it would be tax-free after a lockout period, which would run for a number of years to essentially build enough funds to basically be able to do that no interest loan when you retire. And apologize for the spelling error. It's not smart leverage, it's smart leverage. But how does this actually work? We go to the next page. At a high level, if you're putting money into a retirement account, tax deferred is not tax free. And also, in under number one there, the caps don't scale. So if you're putting money in a 401k, for example, that's good. You're basically deferring taxes and saving for retirement. But that only scales based on the government's rate of how much money you can put into it. So typically, that's not enough money to basically create sufficient retirement income for you to be able to keep your same lifestyle, since you're only putting maybe at most, 10 or 12% of your income away into that retirement plan. Also, what I like to say, number two, is that, a IRA is an IOU to the IRS. So at some point, you actually have to pay the tax on it, and you're usually paying the tax on it when you need to pull that money out at retirement. And if for some reason you're fortunate enough that you don't need to pull the money out, well, when you hit age 73, you're still going to get RMDs and be forced to do distributions. And any remaining money is essentially taxed upon death. And in addition, number three, you don't control the rates in the future. So some future Congress is going to basically set what the tax rates are. Currently, that's the top rate is 30%, 7%. A lot of people believe that will go higher in the future. Also, they're going to potentially set higher AGI limits in terms of taxing your retirement income from an IRA or a 401k. In addition, they would drive, what type of surcharge you would see against Medicare. So if, the more money you make, essentially you pay a higher amount for Medicare, for example. Well, all of these things are really beyond your control. So if you go to the next page, how you can build some control is you can basically take a subset of money where you're essentially putting in a base amount, and then a lender is putting in an amount which is greater than the amount that you put in. So these little gold dots are basically showing over a 5-year period, you essentially would be making payments, but the lender would actually be making payments to the insurance premium over a 10-year period. So you're contributing equal payments each year for the first 5 years. The lender continues to make payments over the 10-year period. And then basically, when the lender stops by year 15, there's going to be enough growth in the policy so we can pay off the loan. Everything else is yours, and you can begin to basically generate income, tax-free income payments from that insurance policy. So how does that work? Well, if you go to the next page, let's say you've got an example just as a case study here of a 45-year-old physician. Let's say they're male, they're non-smokers. We're using Allianz as the company, that's the carrier. Basically, if you're making a 50,000 a year contribution for 5 years, then your contribution would be 250,000 over 5 years. At the same time, the lender would be making a $688,000 contribution. So your total premium into the insurance policy is almost 940,000. You would have an initial death benefit immediately of 1,350,000. So if you're 1 year into this and pass away, essentially your death benefit would pay off whatever amount of money was borrowed, and the rest of it would go to your heirs. That death benefit continues on into the future for the rest of your life. And essentially, the insurance company is putting 2.8 times more money in than you are. So you're not having to take all of your cash to be able to grow this policy. You're putting in, the 50,000, and in this case, they would be putting in um, basically 44,500 in the first 5 years, and then 93,000 in the remaining year 6 through 10. So, and by year 15, essentially, we're going to pay off the insurance, or pay off the debt. So there is no debt. Now, the company that does this, they do this quarterly. So they're basically aggregating lots of investors each quarter, and they're going out and they're going out and getting a big loan. That big loan, because it's a big number, they're using commercial paper So they're paying commercial rates, not the personal rates that you would pay if you tried to get the same loan. It's one of the advantages in terms of how this works. And because the company is actually backing the loan, you're not personally backing the loan. The key thing is here is if you don't make your payments every year for 5 years and you skip in, let's say in year three, you don't make the payment, then you would lose the whole thing. But if you make the payment for 5 years, then it goes on autopilot essentially for the rest of your life. So if you go to the next page. So if all you did is you took the stat 250,000 over 5 years and you invested it in a normal tax plan, and after paying taxes, you'd be able to basically take out about 40,000 a year, starting at age 65 through age 90. So that's about a $1,058,000 distribution or $59,000 distribution. If you basically funded the policy yourself without the leverage from the insurance company, you'd be able to get about 61,000 per year or about 1.58 million essentially in distributions between age 65 and 90. But if you add the premium finance to it, you essentially would be getting 88,000 a year or about 2.28 million instead of if you just put it into investment plan and let it grow, 1,060,000, call it. So the leverage really grows the amount of money over time. And the thing is, in a big way, this works because you're really not allowed to touch it. So once those original 5 payments are in, it just goes on autopilot and grows. Now, the company who manages this, they don't just walk away. They actually are managing this every year and they're actively managing essentially their investments. It is an insurance company, so they're, doing the hedging, et cetera, that insurance companies do. So if we go to the next page, if this sounds like it's of interest to you, the idea is if you're between 40 and 65 and in good health, you're able to commit at least 25,000 a year for 5 years. You can do 25,000 a year, you can do 50, you can do 100. There's people out there that are doing multiple hundreds of thousands per year because they want to create a really big policy and then be able to live off the money and pass money on to their heirs. If you're already maxing out your qualified plans, so your 401k or your IRAs, and this is income that you don't need to touch for 15 years, so essentially you're committing it to your retirement plan and then not touching it, then this might be a good solution for you. So if any of the things that we talked about are of interest, the idea is to, through Tyson's team, schedule an appointment and we can run the numbers.
Thanks, Chris. Interesting concept. If you guys want to get on the list, just scan that QR code and fill that out. If you have questions, please drop them in either the chat or the Q&A. And I'll ask the first question while we're waiting for someone. Chris, can you provide a little context around the about the as far as the back end return? So we're getting 5 to 1 up front on the first deal you went over for tax purposes, and then can you talk a little more about the returns per year in the back end and the hold time and so forth?
Yeah, so on the first one, the fee simple donation, it's really a one and done. When you make the investment, you're going to get your tax savings up front, and that's the reason why you do the investment. That tax savings is, really the return in that tax year. Essentially, when this fund invests, they hold about 25% of the money to the side. 15% of it is held as a reserve as a legal reserve. So basically, because they know they're going to get audited and they know they're going to fight the IRS, they know about how much money they need to do it because they've been doing it for years. In addition, there's about another 10% that's held aside as an investment. And primarily that extra 10% is there because funds that do this really well historically, if they do get a judgment from the IRS at all, they're typically not more than 10%. So they've got the cash there to just pay off the IRS and call it done. So whenever basically it exits audit, any remaining money, either from the legal defense fund or from the investment fund, are then returned to the investors plus any growth that happened over that period of time. Typically, these audits run from between 7 to 10 years. So there could be significant growth, but the reason why you do this investment isn't really the future payout. It's the tax break on the front end.
Got it. So the audits typically happen at the GP level. Have you had any investors that were audited with either one of these plans?
No, and in fact, in 2026, or sorry, in 2016, the IRS actually went after someone that was in this type of a structure. And basically, the circuit court, three judges unanimously told the IRS, not only should you not have done this, but you should never do this again. So the legal precedent is that the IRS is not allowed to go after the GP. Or sorry, they're not allowed to go after the LP. They're only allowed to go after the general partner because of the way the actual partnership is structured. In addition, you'll see if you go look this up, historic preservation easement, fee simple donation, IRC 170A, IRC 170H, you'll see a bunch of stuff on the internet about companies that haven't done well and basically caused their investors to have to pay a bunch of taxes and penalties. Neither one of these companies have done that, number one. But number two, um, those companies weren't really set up properly to begin with. So what we do is in our vetting process, we go look for those types of problems, and we're looking for operators that have their money in the investment too. So I mean, if something flowed through to the end investor, it's going to hit the owners of the fund in addition to the actual investors. But both of these companies have never had an investor audited or pay money back.
All right, very good. And then, yeah, I misspoke earlier. I was actually talking about the second one as far as explaining the returns by year and the
Yeah.
profit whole
Well,
period.
well, they did a change this year. So essentially, what they're trying to do ultimately with this historic preservation easement fund, they want to basically return the investor's original capital twice. So once is when you're getting the tax break this tax year for the investment that you did. And then the second one is actually paying back to the investors their original capital. And their goal is to pay that back over the first 5 years. And they're going to do that in three specific installments. So instead of doing income monthly or something like that or quarterly, they're actually going to do three unique installments essentially over that 5 year period, which would return the investor's original capital. And then basically on the back end, when it sells, when it goes full cycles and sells, um, their goal is to basically return a 5x. So it'd be 4x on the back end plus 1x along the way for a total of 5x.
With an estimated 5-year hold.
Right. Well, estimated minimum 5 year hold, it could go up to seven depending on the economy. So this particular fund, the historic one, actually has two investments. So one is the historic real estate, and they use about 70% of the money to buy the historic real estate. The other 30%, they could put it in their pocket and take as cash, but instead, they're actually reinvesting it into manufacturing companies. And these manufacturing companies are typically heavy manufacturing companies. So what does that mean? Well, like last year's fund, what they did is they bought a sheet metal company that actually manufactures sheet metal. So it basically, gets the raw iron ore, converts it into iron, creates the sheet metal, adds the right metals to make the right alloy of metal. They roll it out into sheets and sell it. Well, then they also bought a stamping company that takes the sheet metal and they stamp it and bend it into pre-configured pieces that are then consumed by other companies. And then the third company they bought was actually a data center cabinet company. So what's one of the fastest growing areas in the country, right? Data centers. Well, they actually bought the whole supply chain to basically make data center cabinets. And the company has been very successful in terms of increasing the number of or increasing the dollar amount essentially of the contracts which they have for this supply chain. So the whole idea is when they buy these companies, they're buying them essentially for, somewhere between a 2x and a 3x on their earnings, on their EBITDA. Now, by putting the companies together and then increasing the revenue for the companies, since the companies they're buying are usually making somewhere between 1 and 2 million a year, when they put all the companies together, then they're somewhere between 3 and 6 million. Their goal is to get it to 10 million because then you can sell the company to an investor and you can get a 10x on the company. So they're buying things at 2 to 3. They're growing the company's revenue and then selling it at a 10x. So So that's how they get the big multiples on the back end, is selling the manufacturing company. Along the way, what they're doing is they're buying these historic buildings, but they're buying these buildings that are either completely renovated and the person who owns it just doesn't know what they have. So they're buying it, putting the easement on it, and then just renting, making sure that it's rented out and run well. Or they're buying a building that might need some work. So typically, over the last couple of years, they would buy three buildings, two buildings that were just, fully renovated. They just buy them and rent them out. And then they buy another one that needs some work. Why would they buy the building that needs some work? Well, the government has a lot of grant programs for historic buildings. So, for example, last year they got a building where they got $6 million worth of grants to improve the building. So, what are those grants? That's free equity to the investors, right? Because they're
And
basically buying a building for like 20 million and then putting 6 million into it. And then now this building's worth significantly more than 26 million.
how has this GP group performed for you guys in the past relative to hitting their goals?
Well, in the past, hitting their goals has included, a 7% preferred return. They have not done well on the 7% preferred return. So what they did is they're instead accumulating that and then essentially paying out, instead of paying it out quarterly, they're doing it in events because they're essentially selling an asset that essentially is generating that revenue. So instead of doing 7% per quarter type of a thing, they're basically, cashing out an asset that then the result of that sale is basically returning that capital. Um, so they were originally promising to do 7% and then paying it quarterly starting in year two. And instead, they're actually doing these events to pay out the cash instead of paying it out quarterly. So that was a change after the fact, that they did.
Gotcha. Donato, do we have any questions there?
First question I'll go ahead and walk people through is the types of deductions you're talking about with both the fee simple and historical tax credits and the mining. Is that applicable to both passive income and active income, or is it only applicable to certain types of income?
Yeah, active, passive, and capital gain. It's actually good for any type of income.
Active, passive, and capital gains. Gross
Yeah.
aggregate, all forms of income this can apply to.
Yep. And it's applied to your AGI.
And that's regardless of whether someone has real estate professional status or not.
Correct. As a matter of fact, one of the things that we've done strategy wise is someone was making $2 million. The historic will basically cut your taxable income by 50%. So they basically did an investment to reduce 1 million using the historic. And then basically they took 1 million and put that into a building and then did a cost segregation study. Since they bought a $4 million building, $1 million down, they were able to get a 1 million in tax deduction from the cost seg, 1 million tax deduction from the historic preservation easement. And that still left them with 600,000 cash to live on tax free.
Wow, fantastic. You already answered a little bit about how the final return is generated through the sale of the assets at the back end. And the other question was, how does the IRS allow investment outside of historical buildings, for example, and taking cash, investing it into historical buildings, and then leftover cash going to manufacturing buildings if the goal is to restore the individual property?
Yeah, the thing is that when we buy the buildings, what they're doing is they're keeping the deduction at a 2.5 to 1. So they're actually, when they buy these buildings, they actually are generating more deductions than they actually need. So essentially, the excess cash, they could put it in their pocket as profit, or they can go invest it. So the whole thing is the buildings they're buying are generating the return, right? And so the whole thing is like most businesses, they run for a profit. So they're just deciding instead of taking a big profit off of it, instead to reinvest that and basically drive a bigger profit in the back end. So basically, that question relates to something that's called stuffing. So stuffing a certain type of asset along with a different one under the tax code. This company, one of the four founders is actually a guy who's an ex-IRS director. He had 22 lawyers working for him in the IRS that prosecuted this exact transaction. So he knows exactly what you can do and what you can't do.
I think that's all the questions we have currently. Um, yep. And one question I wanted to ask for on behalf of our audience this evening: these deductions are the credits or are the deductions?
They're deductions. Yeah,
Okay.
so they're basically considered charitable contributions based on 170A and 170H. So a charitable contribution, for example, the 170A, which is the fee simple donation, that's the same thing if you took clothes to Goodwill, you're doing a non-cash charitable contribution. Um, that's part using IRC 170A, which lets you do up to 30% of your income. Essentially, under 170H, you're allowed to do up to 50% of your income. And then under just the general charitable rules, if you did cash, you could do up to 60% of your income. So basically, you could do 30% fee simple, you could do 20% historic to get to 50, and then you could still do 10% more in cash if you want to. So
And
those
after
do,
someone does, oh, and if someone were to participate in this investment to the tune of reducing their taxable income by 50%, could they then continue to use other forms of depreciation through passive losses or business losses to deduct further?
yep, just like the example I said. Yeah.
And if someone has, if so, for example, if someone is concerned with hitting the excess business loss limitation limit of, I think, around $500,000 for a married couple, they could use an investment like this to reduce their taxable income down, say 50%, and then depreciate up to that excess business loss limitation in order to bypass the maybe excessive income that is causing issues.
Yep, exactly. Because this is a charitable contribution, so it's not considered a business loss.
And then, question from one of our audience members is when companies that they're investing into, for example, have leftover capital and they deploy them into having machinery, manufacturing businesses, do these GPs or operators then do cost segregation and depreciation on those investments and pass that depreciation back to the people who are LPing into these? Or is there any depreciation component on those as well?
Yeah, so basically what they're doing is essentially they're buying buildings cash. That because of the easement, there's certain things that they can't do, like a cost seg. However, what they're doing is then when they sell these buildings, they're essentially returning the investor capital first, which would be return of capital, which is not taxable. And then essentially, once the investors get the return of capital, then they do a 70-30 split. So 70% to the investors, 30% to the company. And then, basically anything beyond that, those original return of capital ends up being long-term capital gain. Yeah, so they're not
Okay,
doing
Tyson.
depreciation pass-throughs.
I don't think we've any other questions left in the chat or in the Q&A, so go ahead and turn it back over to you.
All right, thank you, sir. Well, Chris, thanks so much for coming. I don't think we have any other questions. Thank you all for attending tonight. We
Oh,
already
there was
have,
one other thing I should have
oh, go
said
ahead.
briefly. So last year, for 63 people, we generated $31 million in tax deductions.
Wow, that's fantastic.
Yeah.
Perfect. Fantastic work. Well, everyone, we're more than happy to connect you with Chris as a part of the benefit of being here at the Timberview Capital Audience Network. We'd love to help you not only create more wealth through the different investment opportunities that we offer, but also keep more of that in your pocket through our network of professionals just like Chris. So if you're interested in pursuing any of these strategies, having conversation or seeing how they might apply to you, please go ahead and scan that QR code below. We'll make sure we facilitate any conversations to help you guys investigate these different opportunities that we have. Thank you guys so much for coming out this evening. Have a great rest of your night.
We're going to have a
Thank
quick
you.
breakout session for the Cobb Club members. So those of you in the Cobb Club, stick around, and the rest of you, thank you so much for coming tonight. If you have any questions, just shoot a text here or sign up with the QR code, and we're happy to jump on a call and answer any questions you have. But thank you so much for coming.
All right, Cobb Club members, you should just got an invitation to the breakout room. Go ahead and click join right there. The rest of our audience, thank you guys for being here. See you soon.